Good morning, everyone. Um, I'm going to be talking about market structure, and I'm going to be defining what market structure is. So, like I said, market structure is the basic skeleton of the market. Like, what knowledge of market structure is what helps us understand the direction in which the market is heading to. It helps us create our bias, and then in turn helps us get better entries so that we can move according to the trend. So that's what market structure entails. It's like the basic framework, what you'll be dealing with when you're trying to create buyers, when you're trying to know the direction in which the market is heading to. And we have types of structure. We have when the market is like the bullish structure, and we have the bearish structure. This is for basic market structure knowledge. We have the bullish. The bullish is when the market is trending up, and we have something like this. This is a bullish trend. This is a bullish trend. And then we have something like this. This is a bearish trend. So this is like basic market structure. You know, the uptrend and the downtrend. Bullish structure, bearish structure. In a bullish structure, you just want to be seeing break of structures to the upside like this. You want to be seeing break of structures like that. While in a bearish structure, you want to be seeing break of structures to the downside like this. This is what you want to be seeing in a bearish structure. In the from this, you already know which one is which, so no need to go deep. So what I'll be teaching you guys about is actually the advanced market structure. And in advanced market structure, we have different types of market structure when we're talking about the advanced type, which is the swing structure, the substructure, and the minor structure. So I'm going to be talking about the swing structure because that is one of the most important of them all. I'm going to be talking about the swing structure. Now, the swing structure is basically that part of the market or the structure that tells us where the market is headed, what the market is doing, and what helps us create bias. So the swing structure is basically what we use to understand where the market is heading to and form our bias. The swing structure is mainly spotted on the higher time frames, the weekly time frame, the monthly time frame, the 4 hour time frame, the 1 hour time frame. All these time frames depends on the kind of trader that you are. If you are a swing trader, a positional trader, a day trader, you know the time frames you have to use. For day traders, you use maybe the 4 hour time frame and sometimes the daily time frame for clarity to understand where the market is headed and what to do. Swing traders use the daily, use the weekly. Some use the monthly too. Positional traders use the monthly, the 3 months, the 6 months, so that they can hold trades for as long as a year. That's for that. So the swing structure helps us identify and create our bias because the main foundation of technical analysis and getting entries is forming a bias. Forming a bias comes from um understanding the swing structure, like where the market is headed actually. So I'm going to be drawing This is what we see as a swing structure on the higher time frame. You have something like this. Now, when you see this on the higher time frame, this is a perfect example of a swing structure. A perfect example of a swing structure whereby you have a break of structure on the higher time frame with a full body close. Now, when identifying your swing structures, one thing you need to pay very close attention to is this particular break of structure here. This break of structure, which I marked as BOS. You need to pay close attention to how the break of structure happens. A valid break of structure should be with a full body close, meaning the body should close above with a full body, not a weak. This should be on the higher time frame. It should close with a full body and not a weak. Now, once it closes with a full body on the higher time frame, that is when you fully identify that, oh, a new swing structure has been formed, and now you move to the next step. Now, take note of what I'm saying. The swing structure should close when before a swing structure is formed, you need to see a break of structure on the higher time frame. That break of structure should be with a full body and not a week. And also, it should be with displacement. You should not just see markets come to the high, like it just comes and does not like give displacement. It should go far at least, create imbalance. A swing structure with an imbalance is one of the most valid swing structures you ever see because it has displacement. I'm going to show examples. So now you move to the next step of creating your bias. Now, when we have properly identified our swing structure, now we want to introduce the use of premium and discount levels. Premium and discount levels. We have premium. Now, these premium and discount levels are levels whereby you use according to the trend of the market. Now, if you are dealing with a bullish structure, whether it's on the lower time frame or on the um higher time frame, if you are dealing with a bullish structure, whether it's on the lower time frame or the higher time frame, a bullish structure, the levels you deal with is the discount level because you want to be buying low and selling high. You understand? You want to buy at a low price, then sell it at a high price, just like any business that you're trying to do. Is you also relate that into trading. Discounts is where you buy at a fair, cheap price to sell at a higher price. So discount levels are are the levels you use when you are in a bullish structure. Then when you are in a bearish structure, you use premium levels. That's when you are looking to sell at a higher price. You want to sell it at a higher price so that you make profits. You sell at a higher price and the price continue going down. That's when you make profit because you are selling at a premium level. You want to sell it at the highest bid. You want to look for the highest bidding price there and sell it. You understand? That is how you use your premium and your discount levels. Now, how do we identify our premium and discount levels? That's when you use your fib retracement tool. But I'll be using my box because I set it on my box already. Now, from the high of your swing to the low of your swing, you just place your box like this. This is how you place your box. Let me take out all this. So you place your gun box or your flip tool from the high of your swing to the low of your swing, or from the low of your swing to the high of your swing, depending on whichever way you are doing it, you are going to definitely get it right. So our premium levels when you are trying to sell is always from this 0.5 level, this 0.5 level here is always from this 0.5 level above. That's where we get our premium levels. Then from 0.5 downwards is where we get our discount levels. Now we don't want to, in this case, we are dealing with a bullish structure, a bullish swing structure, meaning that we'll just be looking for our discount levels. And I said we look for discount levels from 0.5 downwards. That's where you look for your discount level. Now, I know that 0.5 is not actually my discount. 0.5 is the point of equilibrium. That's when something is at 50%, is at balance. You want it to be below 0.5. At below 0.5 is where you see your discount levels. At above 0.5 is where you see your premium levels. Now, from this point, I want to look for markets to do this. I want market to come down into this discount level before I see new buys to create a new swing structure, meaning that my um my levels will be from this point here, from this 0.618 level, like this. This should be my whole discount level here. This is the whole area where I want to be looking for buy entries. Now, you don't just mark your discount level and just take entries randomly. You need to now refine your entries. Look for where liquidity is resting around that place, where liquidity is likely to sweep, and the closest POI to liquidity. That's how you use it. This premium and discount levels just helps you know where you should be looking for your entries from. Where is the potential place market is going to likely trigger from and start buying to create a new high. So this is how you use your premium and discount level. You wait for market to retrace back down, then buy up. Now that retracement into your discount level is what we call a substructure. A substructure is not a structure you want to have anything to do with, which is when people be looking for buy for sales to their buy point of interest. You should not be doing that because most of the time is mainly risky to take those type of entries. Now, when market retraces back down, that is called a substructure. Now, a reversal from your point of interest to a new high or a new low is what you call the minor structure. Now, that is expansion. Market is now expanding from your entry. That is what we call a minor structure. So these two structures are just what you will see later on. But what you are working with to get entries is your swing structure. You understand? The swing structure helps you form your bias. It's the swing structure that is going to lead to your substructure and minor structure. Now that substructure and minor structure is what is going to form your next swing structure. You understand? Swing structure is equal to um swing structure is equal to substructure plus minor structure, and minor structure plus substructure is equal to a new swing structure, just like that. You understand? So this is how you use swing structures. Now I'm going to show us examples. I'm going to be showing us examples. So we'll go to the 4 hour time frame. Okay, I think I should use gold for a better example. So I'm going to be using gold for this for an example. I'm not going to make it much, just something you understand. But I think gold created a lot of imbalances. I don't know which one will be perfect to use. I use GU. So I'm going to be using GU in this case. I'll use GU for both a buy and a sell. I'll just give one example each, and I'm going to be doing it from this current point that market is at, because I'll also show you, okay, I'll show you examples of previous places where market did that same thing. So we're going to be doing it in the case of a sell. Let's take, I think many of you have seen the example already from the classes we have had. So first of all, we want to identify the path at which market is running at. And we can clearly see that from this point here, from here, like this, market is mainly bearish here because we're having series of break of structures to the downside. We've been having break of structures. We've been having break of structures from here. We've been having breaks. We've been having break of structures, bearish break of structures, by the way. So now this other top swing that was formed is already mitigated. I don't think I want to go into the explanation of that one. I want to deal with the recent one that happened that I caught, so that it's going to be an example of what I did that worked out. So firstly, we identify the swing. Once we identify the swing here, and this is our swing from this high, from this high to this low here. This is our swing structure. This is our swing structure now. We have a break of structure. We have a sweep of liquidity. Where is our sweep of liquidity resting? Our sweep of liquidity is resting at this top side here. We have that sweep of liquidity. The sweep of liquidity is what led to the break of structure. You can see how I carefully marked it out. So one bearish swing that we have here. Now we now want to identify where we want to sell from. I said we now use our Gantt box or our fee retracement to determine the premium and discount level. Now we do this, mark it out like this. You see why I said you look for your sales from above 0.5, not at 0.5 immediately. From above 0.5, that's where you look for your entries, because it is the higher the price, the value they sell, because you need to get it at a pinpoint level. Now we can see that from here now, all the zones that are showing here, this one here, this FVG, we have an FVG here. that the market likely sells from. We have this fair value gap here. We have this fair value gap. We have that fair value gap there, where the market reacted from the fair value gap too, but it just had to go mitigate the other block at the top side. You just have to go mitigate the other block at the top side. But yeah, market reacted from our premium level here. You can see the reaction, and it went to create a new low, created a new low. Now we are buying from another block, and if as we are buying from this other block, a market fails to respect any zone for a sell, we're going to go back to create a new low. This is how we do it. Now you can either place your sales from this fair value gap. Your SL will be at that high, the high of the swing. Then you take your exit at the low that the swing structure created. That's another way to do it. Any way you want to do it, but you refine your entries. Now for the 4 hour time frame, you can refine your entries on the 15 minutes, where you look for entries at the zone that you marked out on the 15 minutes. You can decide to refine your entries there. On the 1 hour, you refine your entries on the 5 minutes. On the daily time frame, you refine your entries on the 30 minutes time frame. That's how you correlate pairs. So this is one simple way. Now you can place your entries from this FVG. You can place your entries here from the FVG. Target the low. Target the low, and your SL will be here. SL will be here. This is how me will have approached the trade. If you refine your entries, get a more precise entry. But a win is a win. A win is a win. I would have loved to dive down deep into the entry, but this is basically a video for market structure that I want to explain. I want to explain how to use your swing structures and how to identify them. You see how the break of structure here happened? It happened with a full body and it has displacement, meaning it went down. It really went down after breaking structure. It went down. It did not just break structure and start going back up. That it does not have momentum and there is no displacement, so there is no need marking that point out. Now I'm going to show you guys for the case of um a buy. For the case of a buy too, we have this same point here. This exact point I'm buying from is what we have as a case for a buy. Now I spotted this on the um I spotted this on the daily time frame. But we can also use this point to get our swing structure. Now from clear indications now, we know that this is our swing structure from this low here, from this low to that high, this extreme high here. We have this as our swing structure. Now We want to be looking for entries from um 0.5 below. That 0.5 just indicates that okay, that's the point of separation. But anything below 0.5 is where you want to be looking for your sell levels, where you want to sell from. Now, we have had a reaction from 0. The 0.382 level, which gave a fair push to cause the new sell. Now again, we are having another buy from an order block here. Now, this points that the market is buying from is supposed to take us to either break above this high or create a new high like this. This is what we are supposed to see on GU. This is what we're supposed to see on GU. We're supposed to see buys that are going to either take out the recent swing high or create a new all-time high. This is basically how to use your swing structure. The first of all, identify your break of structure and make sure it has displacement, meaning it should push up a little bit. Then you go down and use your feed tool to mark out your premium and your discount levels. Now, after you've marked out your premium and discount levels, depending on the structure you're using, you now go down to the lower time frame. I will explain this once in a later on video when I will explaining POIs. That's when we deal with the lower time frames and the refinements. But for now, you need to understand this. Now, you identify your break of structure. You mark your discount levels. Now, those discount levels, I told you, the the cheaper the price, the better the buys. The cheaper the price, the better the buys. Because anybody that wants to trade GU or buy any asset would like to buy it at a lesser price so that they can sell it at a higher price. You understand? You would like to buy it at a lesser price, at a very discounted price, which is why it's mostly the extreme zones that are more valid because that are the very cheaper price, and which is why these points are marked out for a buy is actually very valid. You can see how market has been reacting. I think this is probably for 2 days now. It has been reacting from this point, and although it's slow, but it's still a fair one. Now whole um this whole trade can fail. We are dealing with probability here. This whole trade can fail, but we are dealing with probability here. But from my own study and all, market is supposed to give us fair buys from these points and then probably tap into a zone and continue selling off or just create a high. But yeah, this is basically how to use um your swing structures to form a bias and then execute. So I'm going to see you guys on the next one, and the next video is going to be on liquidity.